Hello everyone and welcome to another stock market update. Today's date is August 21st, 2021. And today we will be going over the S&P 500, the Russell, the NASDAQ, the 10-year bond, the 30-year bond, and also Dell, a company that I have a position in. So let's get started. Just to recap the week, we sold off a little bit in the week. We almost touched the 50-day moving average, and then we moved up. If we look at all the drawings that we have, you can see that this was a clear area of support, and we fell into here. The bears were not able to push it all the way down to the 50-day moving average, so there was a lot of buying pressure in the market, and the bulls were able to move this up above the 20-day moving average, which is a very good indication for the bulls. They also got past these key trend lines that were broken during the sell-off, and this just shows that the bulls have complete control of the market. When it got sold off here, this is an inside candle, and then this movement higher was kind of expected. This was a really good area to buy. A lot of traders were probably waiting for it to touch the 50-day moving average, but just before everything was bought up. As you can see that a lot of people don't have anywhere else to put their money. Real estate is already really overpriced. Bonds are yielding, 1% or less. So this is what's left is the stock market, and to be quite frank, the earnings have been extremely great. So the market is actually relatively cheap when you compare it to earnings growth and how good these companies have been actually doing. So overall, the market is pretty bullish. We are going into September, which is a very weak month, and that's because the banks have certain deadlines and liquidity requirements, and credit is much harder to come by. So a lot of people are have 20 times leverage or are very levered, and so sometimes they need to pay all those fees back, and in doing so they're not able to lend as easily, and so there might be a little sell-off coming into September. But once September is done, usually around September 21st, 22nd, especially into the first week of October, you could really start buying again, because the market earnings have been great. These are our upside target. This is the fib retracement from the 2008 financial crisis. This is where we're headed, 45.79 and 4600. I think we'll probably reach 4600 by January of next year. So, and this I think we'll for sure get there by December. That's kind of my call here. But short-term weakness, as I said, we might come back to touch the 50-day moving average during the sell-off in September, but we'll see. Okay, next. So this is the NASDAQ. We can see the NASDAQ is a lot stronger than the S&P 500. This one did come and touch the 50-day moving average and was bought up very quickly. Not as much of a sell-off as compared to the S&P 500. It's really strong, and there's a couple companies in here that are making it strong. Microsoft is doing extremely well. Apple is doing extremely well. I think Microsoft right now is like $2.2 trillion company, and Apple is a $2.4 trillion company. So these companies have a huge weighting in the NASDAQ. You can have maybe half out of the NASDAQ 100, you could have 50 of these companies below their 50-day moving average. So they could be down here getting sold off, but single-handedly you have 2 or 3 stocks that are just keeping this market up. So that's kind of just the nature of what's happening. The upside target for the S&P or the NASDAQ is 15,571. This is the fib retracement for the .com era. We are definitely heading up here. Once this breaks, then you can see it. We've been really respecting these channels. This channel, if you can, we can zoom back, is all the way from down here and up, and you can see it's still respecting it. So these trend lines are extremely important, and the market really respects these. I drew this before the market found support here, right? And it's still finding support. So we are in this channel here. So if we just kind of extend that a little further like that, and we extend that a little further, we could see that we're in this range. It might kind of go here, and then we're kind of going up to the upside, and then this is our target to go off of. Okay, next. This is the Russell. So out of all of the three indices, this has been getting destroyed. This is the weakest out of all three. If you had to put money, if you had to choose the Russell, the S&P, and the NASDAQ, I would first put my money right now in the NASDAQ, then the S&P 500, and then the Russell. This has been selling off quite extensively. It's below the 50-day moving average, below the 20-day moving average. The direction is slanting downwards. It's broken, and this is a trend line from all the way back here. It's broken this major trend. You can see that it's been trying so long, since July 27th. It's really been trying to get above this major trend line that it broke, and it hasn't been able to do this. And finally, it got rejected. And you had, let's see, you had around a 6% sell-off. So this is 10% from its highs. And really, since February 11th, it's gone sideways. So we're in a completely sideways consolidation pattern. During the September sell-off, I think that this thing will probably fall. And my target for it is down here. So this is another key support area. You can probably draw it here. I say the Russell, it might move up a little bit in the next week, but by mid-September, so September 15th or so, we're going to be finding it down here. So if there's one thing that I'm bearish on is the Russell. I don't think the Russell is making all-time highs anytime soon. I don't think we're going to get here anytime soon. Definitely the NASDAQ and the S&P 500 are better candidates to reach their target before the Russell is. Okay, moving on to bonds. So we can see that bonds are getting bought up a little bit. We've stopped the fall. Anytime that you have people buying bonds, it means that it's more of a flight to safety type situation. It means that people are not going into riskier assets. So this bond, so this is a 10-year bond, it's yielding around 1.3%. Interest rate for that, and people are still buying it. So 1.3%, there's a lot of people, there's a lot of institutions that are willing to just get 1.3%, whereas a lot of dividend stocks are paying 3% or so. So we're not getting this inflation trade has essentially been stopped by this bond by these bond purchases, because the bond market is not pricing in inflation. Everybody's talking about inflation, but the bond market doesn't think that there's inflation, and they are still buying up treasuries. So typically this is kind of what happens when you get into a risk off type situation, but there's so much liquidity that money has to go into somewhere. And so, as I said at the earlier part of the broadcast, if people are buying up bonds at 1.3%, you can pretty much also guarantee that there's going to be demand for stocks, because people need to get into riskier and riskier assets to drive returns, and 1.3% just isn't cutting it for anyone. So this is a key area of support. It is been going on for a while. Touch here, touch here. It is very important, this level right here. So we've kind of been consolidating. I would not be surprised if we break up to the upside and go here in September when there is a sell-off in the markets. Similar pattern with the 30-year bond. People are buying it up. I think this is definitely moving higher. Okay, so this is a company that I have puts on. So I have purchased roughly 110 put contracts at a price of 2.5 around at the 92.5 strike here. So my cost basis is roughly 100 times 2.5, so that's $25,000 of put contracts on Dell, and they have earnings coming up here in August 26th, and I think this is probably going to sell off and go down here. And if it doesn't sell off after earnings, I think that the sell off in September should put pressure on the stock. But you can kind of see it's interesting. I bought the puts here, and then they came down here, and I had around $5,000 of profit. It was around 20% profit, and I didn't take profits. And it's interesting because if you look here, this is the two channels that we're trading in, and we have this candle here. It's kind of like a doji. It's not quite a doji, but we're in this downtrend. I mean, short-term downtrend. This pattern is sideways, but this is kind of a reversal candle. So, and then we had this move higher, so I reloaded some more puts, but this is probably going to head lower. I wouldn't be surprised if this traded up a little bit, maybe touch this upper channel. I will exit this trade if it can get above this. If we're above 100, I have to sell for a loss, because it is just not feasible anymore. Because that just means that the bulls are pretty much in control a lot, and they're able to kind of break this long-term pattern down. They managed to get it above the 50-day and the 20-day, but we'll see. We'll see what happens next week. I wouldn't be surprised if this is flat next week or a little higher, but I think in September it'll move lower. And that is all. One other thing that I wanted to show you guys was I like to follow this thing called the NFCI index, and this is called the National Financial Condition Index that is released by the Fed. They take into account different risk profiles of the market, leverage, credit, and risk. And there's a whole video about how this is made, and they use 105 measures of financial activity, each expected relative to their sample averages. And so it's a really good measure to see how healthy the markets are and how leveraged people are being. So you can see that during the Corona crash, this really started moving up higher, which kind of indicated that the financial conditions had gotten worse. People weren't borrowing as much, and February 28th, this was kind of before the crash. You could have maybe bought some puts and made some good money, and then instead of buying puts and being on the bearish on the market when everybody was screaming bloody murder and everybody was saying that the market was going to keep crashing, you could have got long, because you could see that the trend is down. Financial conditions are getting easier, and they've been getting easier for a while. Noticeably, since almost mid-July, it's creeping up a little bit. So we're getting a little bit unhealthier in the markets. So as you can see, if you look at the if you look at the credit, so credit down here was 0.29, and then it's getting it's getting more and more positive, which means that it's getting harder and harder to obtain credit. So when there's less ability for people to get credit, then they have to pay back their loans, and that could lead to a sell-off in the markets. Still pretty liquid though. The overall ranking is negative 0.68, which is pretty healthy, means that a lot of people are still leveraged. Financial conditions are extremely easy, but you kind of want to watch this trend. If it starts trending up, kind of like here, I mean, this was a very sharp trend up, but if this pattern continues, expect the markets to kind of sell off a bit more. All right. Anyways, that is all for today. Thank you for tuning in. And if you have any questions, please comment below, and I would be more than happy to engage and answer any questions that you may have. Thanks.